All right, welcome to The Explainer. Today, we're going to dive into a pretty fascinating theory that's making the rounds. It's this idea that the real price of silver, well, it's not being set in New York or London anymore. All eyes are on Shanghai. So what if that price you see on the news is just, a number, and the actual cost to get your hands on a physical bar of silver is about to tell a completely different story? And that right there is the big question we're looking at today. It really gets you thinking, doesn't it? The theory suggests there's this huge disconnect growing between silver on paper and silver in the real world. You have to wonder, is that number we see every day in the headlines just becoming a fantasy?
And here's where it gets interesting. It's really a tale of two prices. Over here in the West, the price is all about financial contracts. People call it the paper price. But over in the East, and especially in Shanghai, what matters is demand for actual physical silver bars. And the whole point of this theory is that these two prices, they're starting to go their separate ways.
Now, this theory makes a really bold prediction. It says the price of silver in Shanghai could rocket right past $73. And get this, not in 10 years, not in 5 years, but on a very specific date, December 23rd, 2025. You have to ask, how in the world could a jump like that happen so fast? Let's break it down. Okay, to really get a handle on this prediction, we've got to look at the financial tool that's supposed to keep prices around the world in sync. It's a process that's worked for decades, but the source we're looking at here argues it's just broken.
So this mechanism, it's called arbitrage, and it's actually pretty simple. If silver is cheaper in one city, traders buy it there and immediately sell it where it's more expensive. This constant buying and selling is like the financial glue that normally makes sure an ounce of silver costs about the same everywhere, whether you're in London, New York, or Shanghai.
Let me walk you through how it's supposed to go. It's a simple 4-step dance. In a healthy market, if the price in Shanghai is higher, traders buy the cheaper silver in the West, they ship it over to Shanghai, sell it for a nice little profit, and by doing all that, they actually help close that price gap. It's like a bridge connecting the two markets, keeping everything balanced. But here's the kicker. The theory says that bridge is now broken. See, when you see a price difference that isn't correcting itself, it really only points to one of two things. Either there isn't enough physical silver in the West to actually ship over, or it's just become too difficult or risky to move it. Either way, the markets are drifting apart.
So what could possibly cause such a sudden, dramatic price explosion? Well, the theory points to 4 very specific triggers, 4 kinds of market pressure that could light the fuse. This isn't just some wild guess. It's based on how markets act when they're under serious stress. Trigger number 1 is all about that price difference, what traders call the premium in Shanghai. It's not shrinking like it should. In fact, it's holding steady or even getting wider. That's a huge red flag that the whole system is clogged up. And you know what happens when a stuck system meets urgent demand? Prices don't creep up, they jump.
Second, we have what's known as a thin market. Think of it like this. It's a quiet country road, not a 10-lane highway. It doesn't take much traffic to cause a big backup. In a thin market, you don't need thousands of buyers to move the price. No, just a handful of large industrial buyers placing their normal everyday orders can cause a massive price spike, just because there isn't a lot of silver for sale at that exact moment. Okay, trigger number 3 gets into that paper market we talked about. Sometimes big banks will try to keep a lid on the price by selling a bunch of paper silver contracts. And you know what? It usually works. But if the demand for real physical metal is strong enough, those paper sales just don't do anything. And when that happens, it's a blaring signal that the paper market is losing its grip on the physical one. And the fourth, and maybe the most powerful trigger of all, is just good old-fashioned fear. Just imagine for a second you're a manager at a big solar panel factory. You absolutely need silver to keep your assembly line running. If you start hearing whispers that supply is getting tight, are you going to haggle over the price? No way. You're going to pay whatever it takes to get the silver you need so you don't have to shut down your whole operation. That's what you call demand that's driven purely by necessity. You know, if you're finding this explainer interesting, we'd really appreciate it if you take a moment to like, share, and subscribe. Your support really helps us keep making more of these breakdowns for you. So, let's put it all together. How might this whole thing actually play out? Well, the theory is pretty smart about this. It doesn't just give one prediction. It actually lays out 3 different scenarios for what could happen on that key trading day. Here they are, the 3 possibilities. First, you've got the base case, which is the most likely. The price just briefly touches $73. It's a sign that, hey, the pressure is really building.
Then there's the bull case. This is the extreme one. The price screams past 73.50, and that signals a real crisis in supply. But even in the cooling case, where we don't get a big spike, if that price gap between Shanghai and the West is still there, it still tells us the market is stretched incredibly thin.
But hold on, the theory doesn't just stop at the price. It also takes a hard look at how the established financial system itself might react if it starts to feel like it's losing control of the situation. And this quote right here really gets to the heart of it. The idea is that the folks who bet on the price of silver going down, well, they're not just going to take a massive loss lying down. Instead of letting the market do its thing, they might just try to change the rules of the game. And we've seen this playbook before in other markets, haven't we? The theory predicts they might start pointing fingers at speculators, or they could suddenly make it way more expensive to trade, forcing people to sell. They might even just halt trading entirely, blaming extreme volatility. It's all about trying to wrestle back control. But here's the thing. The theory argues all of those moves are just a band-aid on a much, much bigger problem. They might calm things down for a day or two, but they don't fix the core issue, which is this: the idea that there is simply more demand for physical silver than there is physical supply. And you can't fix that by messing with the paper market. So to wrap this all up, the theory leaves us with 4 key things to keep an eye on. First, when the Shanghai market opens, what happens to that price premium? Does it stay high? Second, how does the West respond? Do they try to dump paper contracts on the market? Third, and this is the big one, do we actually see $73 flash on the screen? And finally, does that gap between East and West get wider or smaller? The answers to those questions are going to tell the whole story. And that brings us to the final, really big thought here. Is this story just about silver? Or could it be a sign of something much bigger? A fundamental shift in the financial world, a moment where real, tangible things, physical assets, start to matter more than the paper contracts. That's the real profound question behind the Shanghai silver signal.